Hey everybody, Courtney Smith here. Welcome to our first edition from July. And, we've got the 4th of July coming up here, so there's going to be a lot of fireworks. And, this is a lot of fireworks right here. It's just so patriotic. I'm feeling like having a parade. All right, let's take a look at these markets here. S&P 500. We've had this dip over the last 3 weeks, and all of a sudden the market went from being low volatility dip to high volatility dip. And furthermore, we had a nice reversal bar up on Thursday. And so really, I think this dip is over now. Purple Predictor says it's definitely over, and we should start moving higher. But unfortunately, the Dow, not quite so bullish. Yes, it's bounced off that green trend line. That's bullish. But in the purple box in the upper right-hand corner, what we see is that selling pressure, which is the red line, it's coming down, but it's still bigger than buying pressure on the green line, which is coming up. Still net bearish. Why? Well, the reason is because of trade war fears. In other words, what happens is that when you have a potential for a trade war, it affects big multinational companies most of all. And of course, the Dow, all of the companies in the Dow are big multinationals, so it hurts them the most. Then it hurts the S&P, and then finally, it hurts the NASDAQ. So the NASDAQ, not as bad a situation as the other ones are, for sure. The NASDAQ, it's okay. The one that's held up the best really has been the IWM. This is the Russell 2000, and it is composed of only small cap stocks, okay? Only small cap stocks. And because it's only small cap stocks, those are mainly domestic-oriented companies. So when we have a potential trade war, it really just doesn't affect them very much because they're domestic-oriented, not international, multinational. So they only rely on the United States for their business. They don't rely on outside trade. So this looks pretty darn good. Now, we use it as our seasonality indicator, and if it breaks below the red line at 160, which is also where the green line is coming up this week, we'd have to turn the seasonality from bullish to neutral, not bearish, because the summer is not a period of bearishness, it's a period of neutrality. But nonetheless, it would be kicking one of the underpinnings of the bull market out from underneath. So we don't want that to happen, and I don't think it's going to happen. One reason, Purple Predictor is turned a little bit bullish. Now, the seasonality says we should either drift lower to October or we should drift sideways to October. Either way, not a lot of price action. The yield curve, not really going to be a big help to us. It's pretty well choppy and sideways, so it's not going to affect the market for the next year. But I am looking very closely at the lower right-hand corner. The yield curve there is getting tighter and tighter, which means a year from now, that's going to be bearish. Remember, the yield curve leads the stock market by 1 year. Pretty cool. The other thing that's big that's happening in the market is asset allocation. What we're seeing is that as the market came down, people started to move more into bonds, and they started to move more into defensive stock sectors like consumer staples and utilities. And all of that is causing this asset allocation to move money out of stocks into bonds. And at the same time, they're saying, we don't want to take risk. You know what? Let's go buy us some bonds. Let's go buy us some food companies. Let's go buy us some boring utes. And so they're taking risk out of the market. And generally that's not bullish for the market because it means they're not happy. The animal spirits are not going crazy out there. And it's animal spirits that cause big bull markets. But overseas stocks are being hurt even more than American stocks. Why? Because a trade war affects overseas way more than it affects American companies. Why? Because foreign companies are totally dependent on foreign trade. Whereas U.S. companies, most of them could care less. Most of the European countries, 50% of their GDP comes from foreign trade. In the United States, 15%. So this whole trade war nonsense really is going to affect foreign shares much more than U.S. shares. And so the best thing to do is to stay away from them. Now, I said the asset allocation. I said that money was going into bonds. And here we can see bonds are up a bit. Struggling, but they are making, they did make a higher high and then got smacked down on Friday. But I think we have to be bullish on bonds. We don't have to be wildly bullish on bonds, but I think we've got to be bullish on bonds. Take a look at our indicators here. The bond yields are up at the top in green, but you can see the gold line, which is gold, is collapsing. You can see the blue line, which is 10-year treasuries in Germany. It's collapsing. And even the CRB is down over the last week or so. All three of these indicators are suggesting that bonds are going to rally and interest rates are going to go down. Well, if interest rates go down, that's going to have a big impact on a couple of markets. One of them is the U.S. dollar. And sure enough, the U.S. dollar started to crap out on Friday. It's basically been sideways now for 6 weeks. But I think because of the interest rate picture, we have to assume it's going to go to the bottom of this trading range at 93.25. And if I had to guess which way it's going to break out, I'd guess downside. But in the meantime, why bother trading? Now, if interest rates go lower, then that should be very bullish for gold. But it's in a bear market. It's in a clear bear market. So dollar getting weaker, bonds going down, gold should go up, and it's not. And when something goes down in the face of bullish news, that's super bearish. So I'm not short gold, but boy, it is a piece of garbage. I'm certainly glad I'm not long. Let's put it that way. Now, the factors, our short-term critical factors, are neutral. The top one, the euro, is really neutral. The one in the middle is a little bit bullish, and the one at the bottom is a little bit bearish. So these factors are neutral. Oil, I've been wrong on for the last week, and we've seen it explode to the upside and make new highs for the last several months, or actually for the last several years. But I think what's going to happen is that we know that the Americans are going to produce about 1.4 million barrels a day more. And the U.S., the Trump administration is putting pressure on the Saudis to pump an extra million barrels a day. So if we get up around 2.5 million barrels a day extra supply, that should smack this back down into the low 60s, and I really think back into the 50s. So we need to watch the news very, very closely. Nonetheless, the threat of increasing production will probably cap oil at these prices. Now, Bitcoin has been quite interesting. We've had, I told you about the breakdown, I guess almost 2 weeks ago now. And also the purple predictor has been becoming, it was quite bullish earlier, and now not so much. And the trend of the purple predictor is more bearish than the trend of the price. So that's bearish for Bitcoin. We're now down around 5,800, and I think we're going to probably now continue to move lower down to around 5,000, maybe down to 4,000. We've got to get down to the cost of production and start to choke off the new Bitcoins from being mined. So I'm still bearish here on Bitcoin. Now, our upcoming events. Actually, June 30th is over, as you might have guessed. Maybe you just woke up. I don't know. Anyway, but I left it on here because it was super cool and it affects you, the viewers of Wall Street Wieners. And that is because one of the presentations in our virtual summit was I gave the outlook for what I think is going to happen for the rest of the year. So I kind of went up to 35,000 feet. I'm going to send you an email with a link to that for free. So I just wanted to give you advance notice. Please click on it. I think you're going to love the presentation because I go into deep fundamentals like monetary policy, economic policy, sentiment, and so on and so forth. Abe Kofnes is coming up on August 11th to 13th, and he'll be doing the Forex Wave Rider. It's a 3-day course, actually. The first 2 days are edumacation, and the third day is live trading of the Forex market. So that's going to be very exciting. Then on October 18th and 19th, I'll be doing a Futures Forex Masterclass in Dubai. You should probably book your flights now to get those cheap prices. And finally, where do I come up with these stock ideas? Well, nearly all of them come from thestockbutler.com. One of my students put together this amazing website where he goes through and does what he's basically done is systematize what I do. Okay. I mean, I have a few things that are, some ninja trading tactics that aren't there, but he does a fantastic job. And one of the things I do every single week is I go see what are the best of the best stocks. I just go to Stock Butler, I press a button, and 1 nanosecond later, there it is. So I love it. I love it. I highly recommend that you subscribe to it. I think you will love it as well. All right, that's it for me this week. We will talk to you freebies next week. Fully paid up members, just hang in there for just a second.